All right. Continue. So let's go to another learner. Saloni, you can ask me a question now.
Yes, Uncle. So I wanted to ask the difference between growth and value investing.
Very good question. Difference between growth and value investing. Value, what is value? Value, if you look at from a company's perspective, there is a balance sheet of a company. Company has asset and company has liability, correct? Right? Value is nothing but a difference between asset and liability, correct? That's the value of the company or probably the net worth of the company. Okay. Now, if I revalue the asset and revalue the liability, for example, if company has a land, but in the books of accounts, the land is at a cost price. But today, if I see the value of the land, it's very high, which is not shown in the books of accounts, right? So if I revalue the asset and also revalue the liability, liability could be any form of contingent liability, which is not incurred today, but it can potentially come in future. For example, if someone has a lawsuit against the company, and if suppose company believes that potentially there will be a penalty or amount to be payable to the person who has filed the suit, then that is a contingent liability which needs to be accounted for as well. Today it's contingency below the balance sheet. It's a notes of accounts, but in future it can get converted into real liability. So when we revalue the asset and the liability, there is certain expected value of a company. Okay. Now suppose the current market price is X and expected value of the company is 4X. What will you do? You would like to buy, right? Again,
Yes.
let me take another example. Suppose there is a brand and the brand is well established. For example, SDFC brand. Okay. You know SDFC,
Yes.
right? Now, we don't do accounting of brand in India. We don't have a method where we do. We have a method, but generally companies don't do accounting of brands in India. Okay. But there is a value, right? Tomorrow, if company wants to unlock that value, there is certain value the company will realize of that particular brand, right? So if the expected value of a company is high, which is the total value of the company divided by number of shares, if the expected value of the company is high and the current market price is low, that means the company is undervalued.
Yeah.
You would like to buy that company. This is value, okay? It has nothing to do with growth, revenue growth, sales growth, profit growth, etc. Nothing to do with that. The
Okay.
total balance sheet strength vis-a-vis the current market price, there is a disconnection. That's why there is a value opportunity. Now, what is growth? Growth is, as I said earlier, when a sector or a company has a tailwind and there is a high expected growth, and you want to participate in that growth by buying that stock. Okay. So two different concepts. If you get a company which has value as well as growth, that's the most amazing company you can own because there is a hidden value which market has not yet discovered. It's like a hidden treasure with which no one has discovered yet, and you are the first one to discover that treasure. And at the same time, the business also has potential of growth.
Got it.
Correct? Hridan, Aishani, Mahi, is it clear? Okay. Now let's go to Aishani for a question.
Okay, so in one of your videos, you mentioned that we should start with stocks when we are starting to trade. But how long should I track the prices of these five stocks before I decide to invest?
Wow, very good question. So in one of my video, I mentioned that it's called 10-10-10 video. Maybe I would have said five, but my theory is 10-10-10. What I say is when you start in stock market, start with one stock first and cover only that one stock for 1 month. Okay. When I say look at the stock, I'm not asking you to just look at the stock price. I'm asking you to look at the business, study the business, what this company is all about, what is the management saying, etc., etc. Do it for first month, only one stock. Then you go to the next stock next month. So total, how many stocks now you have? Two. Then you go to the third stock. Total, how many stocks do you have now? Three. So for 10 months, you focus on only these 10 stocks over a period of time. Okay. And another 10 months, you have only these 10 stocks to focus. So you have 20 stocks. Sorry, you have 10 stocks which you are focusing in 20 months. By doing that, your learning journey will be very, very collaborative, and you will have a clarity of why stock prices is going up or going down because of XYZ event inside the company or outside the company, which could be a market driven movement also. So this is 10 stocks for 10 months. And also I have a theory that never lose 10% of your capital in any month. So say for example, you invested 20,000 rupees. And in a particular month, if you are losing 2,000 rupees, you don't trade, you stop. But this is more relevant from the trader perspective, who is active trader in the market. Right? The whole idea of doing that is to get yourself comfortable with stock market price movement, the orientation of stock market. Because when we start, it can be overwhelming. There are many, many stocks. There are 5,000 plus stocks. How do I start? When do I start? This question will always remain in our mind. So my model is more oriented towards people who want to kickstart the journey of investing in stock market. Okay, now we have Hidan. Yes, Hidan.
So, uncle, I mean, at an IPO, a stock can be like oversubscribed where more people buy. So, then how does the company decide who to give the stock to and how do they do it then?
Very good question. So there is a process which has been defined for an IPO, process defined by the regulator. Uh, Certain percentage of IPO is for QIP, qualified institutional buyers. Okay, QIPs. There, it's typically proportionate. So suppose if so many uh, bids have come, right, and only these many shares can be given, then the share allotment will be proportionate. But certain category of quota is for retail. Okay, there it's a lottery system. It's like a chip lottery system. So whoever will get is a lucky person. Whoever doesn't get can't help it, come back again. Okay, let's go to Mahi.
All right. So when in the videos you were mentioning on how we could begin with finding stocks which we use in our daily life. For example, Dabur was mentioned a lot.
Yes.
But these stocks, like these companies, have already reached a stage where there is no further scope for like a lot of growth.
Yeah.
So apart from like receiving dividends, is capital appreciation really possible in these companies?
Absolutely. Very good question. So if there is no growth, capital appreciation will not happen. So we should not look at those companies where the growth is not visible, right? But I'm sure in our life, we will see other brands or companies where there is emerging growth. So rather than uh, getting stuck in companies like Dabur or HUL where growth is not there, we should move our money from here to some other stock where the growth is there. So I'm very happy you are asking this question and you're worried about the growth because growth is of paramount importance. And if there is no growth, stock price will not go up because dividend is a very, very small piece of rewarding a shareholder. Let me take this opportunity to explain one more concept to you guys. That ultimately, whatever company makes every year profit, a very small percentage goes as a dividend. Rest stays inside the company as retained earning. Okay. And it becomes part of the balance sheet of a company, right? In the form of reserves and surplus, which is the capital of shareholder. How will a company reward shareholder with respect to those retained earnings? Either company will issue a bonus share, which is additional share shareholder gets by virtue of retained earning or the reserve and surplus, Or if anything else is not possible, then company stock price should go up, right? So if the retained earning is there and it is growing, and if stock price is not growing, there is an opportunity. But if retained earning is not growing because the company is not growing, then obviously stock price will ideally not grow. Okay, Mahi? Yeah, let's go to Saloni.
Yes, so my next question would be, you had mentioned in the video that there are around six metrics which we should consider before investing into a stock. So what does solvency have to do with this exactly? I mean, yes.
So what is solvency? Solvency is the ability of the company to pay interest on the debt which the company has taken, right? As well as to pay back the principal amount which is due. Now, what is debt? Company, when it does a business, it has equity, at the same time, it has debt. A general misconception is that debt is bad. One should not take debt. But the fact remains that every business has its own dynamics, has its own requirement. There are some businesses where debt is required. If you are having large projects like factories and other big projects, then you cannot fund those projects purely from equity. You will have to take debt also because the cost of debt is lower than the cost of equity. Okay. Now, when any company is taking debt because of its business model, if you talk about IT company or a service company, there's no reason why one should take debt because typically service companies, there is cash realization against the service which has been offered. Okay. But if you are taking debt as an industrial company or as an old business company, then you need to pay the interest as well as pay the debt back. So the fact that your profit is sufficient to pay the interest, that is called interest coverage ratio. The fact that your equity is sufficient to pay the debt in case of liquidity crisis, that's called debt equity ratio. So solvency is nothing but checking the credit profile of a company, whether the company is solvent enough to pay back the debt holder. Because finally, when company goes for liquidation, debt has to be paid before equity.
Got it.
Let's go to Hridan.
Yes, uncle. So, my question is, so how does the company know what price their share should be at an IPO?
Very good. Uh, Pricing a company's IPO is like pricing a diamond. Everyone will have their own, point of view for a diamond price. But having said that, there are certain benchmarks for diamond pricing as well. Similarly, for a company's pricing, there is a benchmark. The benchmark depends upon what kind of business the company is. If the company is like a startup, right, where profitability is not there, then they are valued based on certain times of their revenue. Okay, it could be 2 times, 5 times, 10 times, depending upon the growth potential of the company. If the company is an established business with a profitable business track record, then the valuation will be linked to the profit, certain number of times of the profit, right? So every industry will have its own benchmarks of valuation, which is considered as a benchmark. It is not a formula, it's a benchmark. Still, some companies may get higher valuation because of their brand, because of their uh, potential of the business, etc., etc. But beauty lies in the eye of beholder. If there are buyers at a higher price, no one complains. Yeah, we had an IPOs where it was priced at a very high price. For example, Paytm or Zomato and all these guys, because everyone thought these are next generation businesses and they should be valued high. But after disappointment, the market always wait for reality check. There is expectation and there is a performance. If expectation is high and the performance is low, there is a reaction, and the stock price tend to crash in that reaction. You must have heard this stock went down by 20% today. Why? Because there was a mismatch between expectation and reality. And as I've said earlier in my initial part of our discussion, that stock market is all about expectation, right? Because it takes into account the future expected EPS, future forward PE, PEG ratio to value the business at this juncture. Okay, let's go to Aishani.
So, how do we analyze financial statements such as profit and loss statements, balance sheet, and cash flow statements?
Very good. It's a very comprehensive discussion, Aishani. I mean, this is a proper course where every statement has to be properly understood. First of all, the art of making those statements have to be studied. So that's what we do in Chartered Accountancy course, in MBA Finance. We learn that art of how to make financial statement. And then every component of financial statement has to be understood and estimated for future to come out with that estimated EPS, which will give us a fair value of a company considering the future expected earning of the company. So this is a very comprehensive discussion, Aishani, and one needs to go through a very structured learning module to complete that. I think you guys are too young to get into that at this moment. Okay, let's go to Mahi again.
So not directly related to the course, but like a lot of times I've heard my parents and people around me say that companies generally like forge a lot of things on their financial statements. So it's like, how can we completely depend on the financial statements, and what else can we look at to actually find out what is correct and what is not?
Very good, Mahi. You're asking very good questions. Okay, just give me a minute. My battery laptop power is going off. Just give me a minute. All right. So there is a saying in market, it's all about money, honey. And where there is money, you find all kind of people. Because finally, market is a place where money gets transferred from weak slash less knowledgeable people to stronger slash highly knowledgeable people. That's stock market. Now, in that journey, some people will definitely try to deceive other people. And manipulating the books of accounts is a very standard practice which companies resort to, because if they manipulate, they show wrong financials, which creates wrong illusion for their future earning potential, right? How do we protect ourselves from that? Because this is a reality which no one can estimate, right? The simple way to protect, but it is very complex, is to connect the dot, right? And the specialized investors, highly specialized investors, they're smart enough to connect the dots. For example, if suddenly the capex, the number of computers in a company which is into software development has gone up, right? The smart person will maybe appoint a placement consultant and organize a call to the HR of that company and find out whether number of employees have gone up or not. If number of employees have not gone up and number of computers have gone up, there is something wrong, right? So basically trying to connect the dot. If a founder of a company has purchased a private aircraft, a jet for his commutation, that's not justified, right? Why will you invest your money in a private jet when you can do the same thing Even though you take a business class flight, it's okay. But why buying a private jet? That's a red flag. So there are methods of identifying red flags, and those who are totally into market, they are smart enough to find red flags and they manage the positions based on red flag. I'm not saying that people will invest only in clean companies because when it comes to business, nothing can be clean. There will be a bit of twisting and turns and uh, I will not say illegal practices, but practices which you may sound look like you may feel that it's illegal, but actually it's a common practice. For example, tax planning, avoiding tax. You may found that why are people saving tax? We should give back to our country. But planning tax, saving tax is a basics, a DNA of an entrepreneur, right? So there are certain things which are given. You can't really challenge. So basically, people would position size based on the risk tolerance level, right? Just like we do risk tolerance in our friends. Some people are very nice to us, some people are very bad to us, but we are still friends with people who are bad to us, right? And but we know that how much we have to talk. We'll talk little with that person, and we'll talk a lot with a person who is good with us. But we will be friendly with everyone. We'll not fight with anyone. So you actually manage all these things through position size. All right, let's go to Saloni.
Yes. So I wanted to ask that when is it a better time to invest in individual stocks instead of mutual funds or ETFs?
Um, the level of commitment, the effort required for investing in stocks directly is high, is always mutual fund. If you don't have time, you just to invest in mutual fund. If you have time, even if you have say 5 to 6 hours a week, you should also invest in stocks. I don't recommend people to invest in stocks only for money, but I think investing in stocks also help you to become more knowledgeable, also help you to become more updated about economic activities, which eventually helps you in your career as a job seeker or as a businessman. So, to answer your question, how much time do you have is a real answer, and how much passion and dedication you have for this field. Okay, Hridan,
So, uncle, I was going through the videos and I'd seen a business responsibility reports. So, what is a business responsibility reports?
I don't remember that, but my sense is uh, it may be related to corporate social responsibility. That as a responsible citizen, every entity is a responsible citizen. So, if you produce more outputs or data showing that our activity has led to this practice, which has saved the environment or saved the country, certain things, could be ESG report, environment and governance, etc. That is a value added information you want to give to shareholder, which helps a shareholder to believe that the company is sensible as well. They're not just here to make money, they're here for nation building and they're adding value in society as well. Okay, Ida, let's go to Ishani.
So, what are some common mistakes beginners make when they invest for the first time, and like what are the biases and pitfalls we can avoid as a beginner?
Good question. So, as a beginner, we are very excited. We are very overwhelmed with market. We just want to do anything and everything. It's like someone who has learned the game for the first time and they just want to go to the pitch and play sixers and 4 runs. So there are a couple of biases which we have as an individual, like for example recency bias, overconfidence, and all those things. So everything has an application in stock market. Typically, there is a journey to get into stock market. Just like if you want to become a doctor, there's a journey. If you want to become a lawyer, there is a journey, right? It takes you 4 or 5 years to actually go through that learning journey and then start producing output after 6 or 7 years. So stock market is also a journey. One has to start, one has to pace that journey. at the pace you can do it. That's the beauty of stock market. It allows everyone to participate based on what kind of pace you want to incorporate and go slow. The first stage of the journey is learning journey, which you guys are already going through with me. But I'm sure there are other sources also you will adopt where you will start learning. The second stage is learning by doing, where you will start a little bit of money. Maybe you take some money from your parents, 50,000 rupees, tell them that give me a demat account, I want to try. Until unless we do it, we will not learn it. Some money has to be lost, some money has to be given to the market as well for you to get the full real learning. And then once you are comfortable in say 2, 3, 4 years, you build a extra specialization in one domain. It could be trading, it could be investing, it could be any domain which you feel you would like to excel on. So the third is the level of specialization. And finally, the fourth stage is that you have to practice all the risk management and money management techniques that you should not get bust. Because the last thing you want to do is lose a lot of money in market and get out of the market and cribbing about the ecosystem. So it's a journey, Yashani. I think first stage is learning, which you guys are already going through. And learning cannot be sessions like these. Learning is more subconscious mind. When you are traveling, you look at advertisement hoardings and you try to see, oh, this company is giving advertisement. When you're looking at TV, you look at advertisement. When you're buying any product, you go see behind the product, which is the manufacturer of this product. So consciousness towards knowing the companies and the businesses they are doing, that is your habit of participating in market. Just by attending classes, you will never be able to make money in market. We can obviously feed that desire of consciousness inside you, but finally your habit, everyday daily habit, should have an element of market for you to learn the market fully. All right, guys. So we'll call it off for today. Again, next Sunday we'll meet for half an hour. In the meanwhile, you can uh, take your question down and don't hesitate. We have a WhatsApp group, so you can keep posting there as well. You don't have to wait for Sunday. The best way I prefer a question is to add your audio chat. So WhatsApp gives us a great facility where you can send me an audio question inside that group where we are there, and I will reply as per my availability. But for sure, we'll meet next Sunday for half an hour to discuss things further. All right. Thank you, everyone.
So, Uncle, 1 second. So, we've
Yes.
completed the 2 courses. So, what do you want us to do now?
Oh, yeah. Good. I forgot to mention that. So you have completed both the courses. Now I want you to start this module, which I'm going to share with you. Just a minute. So you are done with A to Z of finance. Let me. All right. So what you're done with A to Z. So you're done with A to Z of money, finance, and stock market. Money,
Hmm.
anyways, you guys are old enough not to do money, but we are done with this, right? Now, what
Yeah.
I want you to do is uh, download Stockage app on your phone. Go to Stockage Learn section. Can you see the screen?
Yes.
Inside this, you have this Learn to Invest. Okay? Can you see this Learn to Invest?
Yes,
Start
yes.
this. There are 15 videos of Learn to Invest. Now start this. Then we do this. Then we do these 30 videos. Okay? All right? So Learn to Invest. First 15 videos. Start. I'm not expecting you to complete this in 1 week because all the videos are now deep. Whatever learning you had till now was fast paced learning. But now every video will be deep and you'll have to practice also. And every video will have an Excel sheet attached. So you'll have to practice. Until as you practice, the concepts which I've discussed in those videos will not be able to understand. Okay. So even if you do 2 video, 3 video a week, it's okay. Don't worry. All right, guys. Have a good Sunday. Enjoy. Bye.
You too.